Test. Hello. Hello.
All, may I request all our esteemed speakers and the guests to kindly take seats as we would like to start. So, ICC is extremely happy to have all of you with us on this important theme. There are a lot of exciting and challenging views on the Indian economy, and Union Budget is, I think, few weeks away. And everybody is looking at India as the engine of growth. So at this point of time, this session is really timely, and we have some of the best speakers and the experts who will be sharing their insights with you. To begin with, I'll request President of ICC to formally welcome all the guests. Thank you.
Ladies and gentlemen and friends from the media, good morning and greetings from the Indian Chamber of Commerce. It is my honor and privilege to welcome you all to Indian Economic Outlook 2018, The Vision, a day-long seminar being organized here by the ICC. On behalf of the Indian Chamber of Commerce, I would like to take this opportunity to extend a very warm welcome to our panel of luminaries. Professor Arvind Panagaria, Columbia University; Mr. Yokoyama, Country Director, India, ADB; Mr. Devendra Kumar Pant, Chief Economist and Senior Director, Public Finance, India Ratings and Research of Fitch Group Company; Professor Sudipto Mandal, NIPFP; Mr. Sanjeev Sanyal, Advisor, Ministry of Finance; Mr. Tamal Bandhopadhyay, Consulting Editor, Mint. It is also my pleasure to welcome Professor Chandrasekhar, JNU; Mr. Nahata, Power Guild Treasuries Inc., Dr. Srinivasan, CAFRAL and Professor at NUS; Professor Agarwal, University of Manchester and former Director, IEG; Professor Nanda, Associate Director, TERI; Ms. Venkateshwaran from the Bill and Melinda Gates Foundation; and Professor Agarwal, IIT Delhi. The different sessions in the forum today will be anchored by Mr. Pramit Pal Chaudhary, Foreign Editor, Hindustan Times; Mr. Nishid Hazari, Asia Editor, Bloomberg View; Mr. Stanley Pignell, South Asia Business and Finance Correspondent, The Economist; and Mr. Nitin Jaiswal, Bloomberg's Head of Market Specialist, APAC. In a world that is increasingly connected through technology, geoeconomics is crafting new policy paradigms which are regulating production structures, consumption dynamics, and trade flows globally. IMF's World Economic Outlook for October 2017 places sustainable growth as the new agenda for the world order. The world is looking at a 3.7% growth in 2018. Broad-based upward revisions in the Euro area, Japan, emerging Asia, emerging Europe, and Russia have more than offset downward revisions from the US and the United Kingdom in 2017, forming up the baseline outlook for the world economy. The imperatives, however, for all major economies remain the same: expansion of output and employment, inclusive growth, and creation of a resilient economic and financial architecture. The one-line answer to this has been rightly quoted by OECD Secretary General Angel Gurria. There is a need to focus structural and fiscal action on boosting long-term potential as monetary policy support is reduced. Countries should implement reform packages that catalyze the private sector to promote productivity, higher wages, and more inclusive growth. The OECD projects 2018 growth rates as 7% for India and 6.6% for China, making Asia the world leader and epicenter in terms of economic activity and global growth. The US is projected to grow at 2.5%, while the Euro area and Canada are projected to grow at only 2.1%. Russia, Brazil, and Japan are projected to have even lower growth rates. India's growth prospects have substantially improved courtesy its policy activism, economic reforms, demographic dividend, and positive investor sentiment. The government's recapitalization move has added a lifeline to the banking sector, which was suffering from asset quality concerns, deleveraging in the corporate sector, and slow credit growth. For a debt-financed economy like India, going high on a startup boom makes the vision clear. Growth has to be at the grassroots, both in terms of output and in terms of employment generation. It is also important to ensure that economic growth must be growth with equality. Herein, government-sponsored expenditure on social infrastructure, social entrepreneurship projects, and social businesses emerge as an important means of inclusive growth. With so much happening in the country, India will be the lead driver of the global economic order. But there is a lot more one needs to think about when it comes to driving growth in the Indian economy. Should India increase public expenditure even at the cost of breaching fiscal responsibility and budget management? Should it work on managing exchange rates through interventions? Should the monetary and fiscal policies become more aggressive even if it means high rates of inflation? How should the country address the situation of jobless growth? Today, as we kickstart the very first edition of the Indian Economic Outlook, our panel of economic theorists and practitioners will look beyond breaking news and profess on the way ahead, identifying opportunities and threats for Indian entrepreneurs in the global context. They will also put in perspective India's policy advocacy goals, which will need to be aligned to its growth objectives. I am confident that today's forum deliberations will help set the development goals of the Indian economy and outline models to ensure the right thrust for active participation of every part of the economy. I would like to end by once again welcoming all the dignitaries and respective people from the media houses who have very graciously agreed to conduct the sessions for us today. Thank you so much.
Thank you, President. We would like to now start our first session. May I request Pramit to kindly take over and kindly join us on the stage. Please welcome him with a round of applause. We are extremely honored to have Dr. Arvind Panagaria with us. Sir, may I please extend a warm welcome to Dr. Panagaria, who have kindly agreed to be with us. May I request Mr. Yokoyama, representing ADB here. Please welcome him for gracing the occasion. Dr. Devendra Kumar Pant, Chief Economist, represents Fitch, the India rating. Please welcome him. Senior Vice President, ICC, Mr. Rudro, please join us. And I now request Pramit to please take over and conduct the session. Thank you.
Thank you. The election year for India. Oh, okay. And I remember many years ago, I was talking once to an American farmer, I think it was in Vermont, and he said, as we would all know, that he says, oh, in America, every time there's an election coming, then the economy grows because the government will spend the money. So all we need to have is an election every year and we're fine. That obviously is not that easy. And this year, I think, among other things, and I hope the panelists will bring this out, is that we will have the pressures of an election, but the fact that we will also have the pressure of maintaining a certain degree of fiscal discipline in the economy, and the degree of leeway, my sense is, for the government in this coming year will be somewhat limited on the financial side. But anyway, we have a distinguished panel to discuss this in much greater detail and knowledge than I would have. And I'll begin with Dr. Arvind Panagaria, who we have known in India more recently in his role in Niti Aayog, but of course is now continues as his position as Professor of Economics at Columbia University. So Dr. Panagaria, I will ask you to begin and give us a sense of where you see the present status of the Indian economy, and particularly given perhaps what I've discussed in terms of the limits that we face.
Thank you. Very pleased to be here, always invigorating to be back in India. Sorry to be a little underdressed today for the occasion. The airline lost my luggage, so that is the explanation. No disrespect meant to the hosts. Let me just, I'll take 2 or 3 minutes to give out a little bit of introduction, which I think then that can help us get started off on the discussion. So as you all know, the Indian economy grew under the present government during the first 3 fiscal years at 7.5% on average. So that's 14-15, 15-16, and 16-17. And then, of course, we also know that during the last 2 quarters, the growth rate has been a little tepid. It bottomed out at 5.7% in the first quarter, and then has just come back up to 6.3%. I think things are now looking up. I certainly expect this recovery to continue. I should say that this is recovery in the growth rate, not recovery in the economy, because 6.3% growth also is a lot of growth, and particularly if you see it in the global context. Now, where we expect to go, there is I think, as I haven't seen the report itself, but there was a report on the report in the, I think, Times of India today. World Bank has put out something, and which is very upbeat. I largely think that that report gets it right. For 2018, it puts the growth rate for India, it's about 7.3%. You know, whether it will be exactly 7.3 or not, but it is in the right ballpark, I suspect. And we should expect this recovery also, particularly this time around, to be led by the private sector. A lot of good things happening finally. You know, the initial shock that came with the GST, which was anticipated, will gradually diminish, and the benefits of the GST will begin to take root. But very importantly also, I think, you know, the stressed assets that were stressed for a very long period of time, finally the Reserve Bank of India and the Finance Ministry are addressing it. And I think that's a very, very important development. You know, since it's happening in Mumbai, we probably don't pay enough attention to it, but I think that is going to be very important. A lot of the assets which, you know, some of these, of course, will be in effect retired because they cannot be revived. But lots of other projects actually, which very large projects which had been suffering, not growing, will come to life. And I think that by itself is going to make a contribution. But also I see now that the private investment is beginning to take up. We didn't have much details on the on this in the latest press note of the MOSPI, which only gave basically an estimate for the entire year. But it doesn't bring in the third and fourth quarter GDP. I mean, well, fourth is still away, but meaning, you know, even for the third quarter, we didn't have exactly what the growth rates actually were. But this was, so therefore, this was very much of a forecast. But the previous note, which put out the growth rate figures for second quarter, that actually had some information which suggested that the at least in the second quarter, when we went from 5.7 to 6.3%, this was actually led by the private sector, because if you look at the government expenditures, both current and capital expenditures, they grew much more slowly than was the case in the second quarter of the last year. And yet the investment in aggregate was roughly where it was last year, only tiny bit hair's breadth lower than last year. So I take it that was due to the private sector now finally coming back into action much more strongly. Also in the second quarter, the manufacturing growth was significantly high, and since then, much of the information that has come out in terms of the index of industrial production, etc., it all looks quite good. So I generally think that we are on the way to eventually getting to the 8% mark that we hope to be in another year's time. Thank you.
Thank you. I'm going to turn now to Mr. Yokoyama, Country Director for the Asia Development Bank. And what I'd like to ask you to look at is the issue of infrastructure, which of course is what the ADB in particular has focused a lot on in India. As Dr. Panagaria has mentioned, the government has expended a huge amount of its own money in the past few years on infrastructure projects, partly to maintain growth. But do you see return in particular in the private sector in this area? And what are the other comments you'd like, whatever other comments you'd like to make on infrastructure in India?
Thank you very much. I first really appreciate this opportunity to be here in this prestigious occasion. Let me just cover infrastructure kind of prospects based on our kind of day-to-day operational discussions. And as you know, presently the India infrastructure investments, I think the 12th five-year plan ended up with annual investment of about $100 billion, whereas the target was almost 150% of that amount, or even higher. And IDB recently undertook infrastructure needs assessment, and our estimate is that India needs annually $230 billion. And if you look at these needs and actually what's happening, I think the largest gap is still in the urban infrastructure sector. And you may recall that in early 2000 there was a high-powered expert committee who suggested annual urban infrastructure investments like 3 trillion rupees per year. Whereas at that time, I think the discussion was actually investment is probably 1/8 of that amount. And still, I think this area, I mean, the actual investments which is happening, if you combine the major schemes like Smart City, Amrut, Swachh Bharat, Urban, in combination, still, I think maybe 10 to 20% of what this committee has suggested. So in that sense, there's a huge longer-term requirements for the country to move ahead, particularly urban infrastructure. And for that, I think the present constraint is not only financing, but also the kind of demand side in terms of there's a lack of huge lack of investable proposals. And so I think the Ministry of Urban Development and Housing Affairs has crafted a very comprehensive roadmap for each municipalities in the context of, I think, Amrut programs, to come up with the reform programs in terms of governance, in terms of capacity building, in terms of some reforms on urban property tax, longer term planning, as well as the sort of incentivizing the urban investments for more vertical and concentrated development. So the framework is there. I think a push really needs to come to those soft areas of more planning, longer term planning, preparing investment proposals. So that, I think, is a critical constraint on the infrastructure side. I think the logistics side, a lot of things are happening in terms of Swachh Bharat, the Bharatmala, Sagarmala. And then the government has started logistics in a pretty much emphasized manner. So this is highly promising and can boost, but I think urban infrastructure side requires a lot more investment. And also we see needs for more investment on the low-income states, boosting infrastructure investment. In terms of private sector, I think the KELCA committee has provided very good reports in terms of recommendations. I think a lot of things happening to implement this, but this is a sector requiring a kind of very dynamic and complex management, and I really see the need for government establishing a very strong evidence-based center of excellence to learn from the ground level implementation and adjust the implementation mechanism. I think based on our day-to-day operation, it looks that India still needs a lot of kind of public involvement in PPP investments. So in a sense, in urban areas, there's lots of bankable projects, but it's only not fully bankable. It's only partially bankable. So in that sense, more public involvement is necessary, and also incentivizing private sector, not only doing investment, but also doing the planning side. And design and planning is also important because somehow the planning capacity, as I said, is pretty much constrained. So those are some areas, and PPP, I think we need more rejuvenation, but that's based on the KELCA committee. Thank you very much.
Okay. Thank you. Now turn to Rudra Chatterjee. Rudra, of course, is the Senior Vice President for the Indian Chamber of Commerce, but more importantly on the ground, you run a carpet and a tea company which are very focused on exports. So where do you see, as a corporate person, where do you see the economy right now, and what are the concerns you have?
Thanks, Promit, and thanks for the comments from Professor Panagaria and Mr. Yokoyama. The concerns that were voiced in an overall positive picture was in private investment. And that is the area where we live and operate in. And while when you look at the medium to long term, companies have grown rapidly. Many of the companies have sizably increased their business, Indian companies. But over the last few years, there have been both global and domestic issues that the companies are grappling with. My experience in the tea company, where the big demand is domestic, is muted demand, both in urban and rural areas. And this has led to lower investments for growth. There seems to be many companies in the FMCG sector, and which is a mainstay in the Indian economy, the internal consumption, where there's excess capacity, there's huge pricing pressure. And that means that while there is money available through internal generation because of profitable years in the past, there are not that many investable opportunities for these companies. For the export business, many in the audience are in that field, and there has been both this year the global growth rate, as our President spoke in the beginning, the global growth rate is picking up, but we've come through since 2008, 10 years of very, very sluggish growth, despite immense asset build-up by central banks. That slow global growth and lots of technological changes. For example, in the carpet business, we fight machine-made competition from different countries. And that has made the environment difficult. But also, there are many things that, while, as Professor Panagaria said, and I read the Times of India report, the World Bank talks about India growing at 7.3% in the next year, and praise the ambitious leadership that is carrying out comprehensive long-term reform. But there are areas which have been difficult and continue to be difficult. For example, we all know, and successive governments, starting from the Vajpayee government, the Manmohan Singh government, and the current Modi government, has spoken about the labor reform, the need for labor reform. But even today, the total number of Indians who pay Provident Fund is 4.5 crore in a country with a population of over 100 crores. The total number of taxpayers is 6.26 crores. The challenge of that is the focus. The labor laws are focused on the current people who are working, making sure that they are difficult to remove from employment. But I think the opportunity lies in a young country with a huge labor pool, that it makes us easier to hire people. For initially orders that we receive from customers, we cannot guarantee that they are permanent. We need to react whenever there's an order and manufacture that product. And if they're permanent, obviously we want to keep the workers, but if they're not, we cannot be saddled with that. Similarly, when it comes to issues like land reform, I will only speak from my experience, which is in the tea business. The tea industry has millions of hectares of land. the industry has changed. It has changed several times. The kind of tea that was produced, converted from orthodox tea to CTC tea, so the production increased. Africa started producing tea. Small growers, small farmers started producing tea. So supply has tremendously increased. There are a lot of tea company owners, and it's the same with jute. They own land they would rather use for other purposes. But regulations stop that from happening. And there has to be a process of exiting one industry and getting into another. So that is the significant challenge. We see great opportunity, the massive consumption base, the growth rate of Indian economy, the world economy is also picking up. I think Indian businesses are very competitive in the global environment in all the industries that I see, which becomes a challenge. And another issue is, all the reforms that happen over years, these are necessary reforms, and business is only one part of society. But those reforms come as exogenous shocks to business, unanticipated exogenous shocks. And, given how challenging the environment is already, business has to, it's essentially reels from one shock to another. And this has been the case for decades, and that is, my input.
Okay. So last person on this round, Dr. Devendra Pant from India Ratings and Research. And I notice, of course, that you handle, among other things, public finance. So the fiscal deficit is definitely on the government's mind, and in fact, I believe Prime Minister is holding a meeting today on that issue. Where do you see this as a problem? And perhaps you could also mention that given where we're seeing bond curves, bond yield curves going, the signal that's sending in terms of the concerns about the fiscal situation.
Look, fiscal situation has been a concern, and the concern is mainly emanating from the revenue side. If you look at the central budget of this fiscal, there was no change, not much on the indirect tax side, and rightfully so, because the GST was supposed to come in. When we looked at GST, we were hopeful that collection over a period of time will improve. But the kind of problems we had seen, which I think most of the people, those who are paying GST, filing returns. In fact, yesterday also they talk about further problems in that, because the moment a large number of SSEs go and start filing tax returns on the network simply collapses. So these are the problems which they are being faced by them. So direct tax front, there's the good news, because the up to December number shows healthy growth of 18.2%. So fiscal slippage is a reality. And when government announced another 50,000 crore borrowing for this fiscal, that more or less puts a stamps on it, like the fiscal slippage from the 3.2. So maybe they have to invoke encasing committees, new FRBM framework, escape clause of 0.5 percentage point of the GDP, additional fiscal. But if we are talking about the bond yield, we are talking about the fiscal in India, we should not close our eyes what is happening at the state level. Now, unfortunately, what happens is, because the data of even FY18 state budget that will be released by RBI somewhere 3 to 4 months down the line. And since the data is so scattered, it is Herculean task to combine that data. Now, if I look at that, in the year 15-16, aggregate state fiscal deficit was 3.1%, which went up to 3.7 in 16-17. They have budgeted for 2.7%. But if we factor in all what is happening, farm debt waiver, the state which are now going into election, they will loosen their purse, some this year, some next year. So we are estimating that it will go up to 3%. So put together, if I look at last year, we were 3.5 plus 3.7, somewhere around 7.2. This year we're going to come down to 6.5. And the bond yields have run up the moment the fiscal deficit started becoming a reality. But when RBI has put in state borrowing calendar early this week, after that, bond yields started correcting. So there is a disconnect, and the problem of disconnect is coming because unlike the central government fiscal deficit data, which is available on monthly basis, state-wise data is not available, and they are almost borrow in the market almost of equal amount. So this is what is happening on fisc side. More so from the general government point of view rather than the central government only.
Dr. Panagaria, coming back to you. Now you've mentioned, as you said, that we're starting to see a slight uptick in private investment in terms of a slightly better situation in terms of stressed assets. The policies are now more or less coming out, and the numbers are coming in a little better, at least in the past quarter. But going back to what has been mentioned here now, we're looking, however, at an election cycle that will constrain the government's ability to be so patient in terms of waiting. How bad do you think that will be as an issue? Do you think, what would you recommend to the government in the coming budget, given that it has these two different problems or goals in mind?
So I imagine that this is a question about populist spending during an election year. My own reading and having participated in many of the discussions that used to take place around this time for the budget is that the government here is very responsible. It certainly believes in fiscal rectitude, and it is not an accident that we saw the fiscal deficit of the central government steadily coming down. Now in this year, what may happen is that you see the fiscal deficit really staying at 3.2%, meaning for the coming year, for the year 18-19. I would be very surprised actually if the government goes on a major spending spree and pushes the proposed deficit in the next budget to even say 4%. I certainly don't believe as of now that is going to happen. The government has put in a lot of its effort towards fiscal consolidation. So that's what would be my advice? I think, in terms of any of the populist spending, I believe much more in what I've been calling the Tamil Nadu model, that you distribute televisions and you distribute maybe, some goodies during the election to please the voters, but don't start any programs which have been thought out in a hurry, and then they become permanent fixtures on the budget over the years to come. I think that creates, that causes much greater damage, that causes long-term damage. But if you instead indulge yourself in expenditures that are one-time expenditures, I think that's much preferable. I just want to touch what Rudra said. I was very pleased to hear what you said. About calling for the reforms in both labor laws and on the land front. I think these are, on the capital markets. There are three factors of protection broadly: land, labor, and capital. And on the capital front, we have still done a lot better. But labor and land, they have been really still, we have a bit of feet dragging or foot dragging. I think I'm very pleased that the industry, because I've generally complained when I was in the Niti Aayog that the industry doesn't say enough about these things. In the end, industry also has the responsibility to see that there is a labor force of 500 million people. What are we going to do with the workers? So I was very pleased to hear. I totally endorse what you said.
Mr. Yokoyama, you mentioned the urban gap, that the real gap you see in infrastructure is on the urban side. What specific policies would you expect, perhaps in the next budget, would you recommend to the government to handle this? Particularly in this election year, at least, the urban vote is going to be what the government will be banking on, I think, to get itself through.
Yeah, I think we are more working on a longer term perspective, and for shorter term, actually, we cannot expect such a short-term solution in the urban area. They really need longer-term urban plans, investment proposals, and the constraint as of now, as I said, is really lack of readily investable proposals. So at this stage, I think probably some kind of inspiring kind of, not budget, but planning process be inspired to the urban people, that the government is really moving forward to rejuvenate the urban development process. And so in a sense, of course, in terms of quick solutions, there should be a lot of emphasis on faster implementation in terms of that. That also is, quite a laborious area of, engagement. So in a sense, what I mean to say is really this urban rejuvenation is a time-consuming process, and really, but the thing is, the process really starts to. Our view is the process really needs to start now, and in a massive way in terms of planning and urban reforms.
Now, as you mentioned, that land reforms has been a big obstacle, an area where the government hasn't moved very far. Do you see that in terms of, especially, let's say, for example, the Western Dedicated Freight Corridors, 2,500 lawsuits, I think, now have stopped it from moving forward. Do you see land reform as being probably the most important for these large-scale infrastructure projects?
In a sense, when you look at the, of course, now the constraint is really the land price has increased quite a lot and pressurizing a lot of the investment processes. So, of course, the reforming land laws, but this is a very sensitive matter, and of course, what we have been really advocating is in the context of urban planning, please move ahead more on the land pooling approach, where I think the Gujarat and some states have made excellent progress, and making sure that the benefit also accrue to the landowners in terms of not only selling, but there could be land pooling, and they are getting the land price increase and more benefits. So that approach really needs to be advocated. And we see in the urban cluster, industrial core cluster development, there's a huge opportunity to manage that.
So do you see the model that, let's say, Andhra Pradesh has introduced, do you see that as being sustainable? There's been complaints that is extraordinarily expensive in terms for the infrastructure developer.
But I think this one is a kind of approach, at least we understand in Gujarat, has been pursuing in a successful way, and how to approach to the local population and managing expectations and what are the outcome of this. And I think the model has been widely practiced, even in case I remember in Japan. So this is a way to combat the very congested low-rise based urban areas into high-rise. There's a lot of approach taken and policy level emphasis taken to really change the land use pattern by inviting the landowners to the process of urban more concentrated development.
I just say, as a journalist, I would like to have said, put a heading to your statement and saying an ADB official says Gujarat model adopted in Japan. It'll get you into a lot of trouble.
I don't mean to say that, but in case of, when Japan, Tokyo used to be a very, kind of area like Delhi. Yes. It was a low-rise, small housing is occupying very congested way. Now, if you go there, this has been converted to a very high-rise, based tall buildings. The way they did is approaching to the landowners of individual households and motivating them to convert their land use to build high-rise buildings, and there's a lot of private investment coming in there. So in that process, I think there are a lot of opportunities to learn from that.
So, Rudra, you mentioned the problem of domestic demand in India. And first I'd like to ask you, so do you feel that corporate India has now largely absorbed the shocks of demonetization and GST? Is that over? Second, though, you are relatively pessimistic about the trade front, and that continues to be, I mean, that is one of the 4 areas of growth that you should be hoping we're supposed to be getting something out of, but it doesn't seem to be taking place. What would you say on that?
I think there were industries, in my experience, which were not at all affected by demonetization. Like our carpet industry, we didn't feel any adverse effect due to demonetization. And there were industries that were significantly affected, like real estate. I don't see currently from a corporate perspective that we speak about demonetization being a drag on our investment plans. I think the fact is, even before demonetization, demand was muted. And that has not picked up significantly. And a lot of it is, has been a secular stagnation for demand. And I don't know where, because there is still significant excess capacity in industry. When you look at some industries, the answers are like steel and power, cement. There's probably excess capacity in China and other countries which has contributed to the problem. Professor Panagaria talked about the debt crisis which have affected many of the companies. Even healthy companies are not able to borrow significantly when they do have an investment plan. So that, but I don't think specifically, I don't think demonetization was for corporate India as big an issue. With GST, I think what happened is prior to GST, there was a significant drop in demand because there was little, there were lack of clarity about what GST would entail and how business had to, draw down inventory and other current assets, and that led in across businesses drop in demand. But everybody recognizes that GST would simplify processes, reduce transport times, and in one example that I have, which I like using, is in tea. We used to compete with local players who would not pay sales tax. That is no longer a good option because there's a GST of 5% on tea from the manufacturer and a GST of 5% on the packaged tea. So those are advantages of GST that we see. The bigger issue is the way in which these sudden changes hit us. GST was not a sudden change. We were expecting it, we were seeing it happen. But from retrospective taxation to, it's just been every year there's been a couple of things which may be necessary for the country, but a business person wants to plan ahead when we are developing capacity. And oftentimes we see that that capacity is not getting utilized, not because of demand, which is something that we anticipate. That is part of the job of our business to create demand, but some exogenous shock which affects the industry.
Before I turn to the audience, so Dr. Pant, Dr. Panagaria believes that the government will hold to its fiscal, at best to have a little wiggle on the fiscal side. Presumably, however, we will then see problems on the demand side in the economy. Do you see that as being, will we see a slump in growth? Will we see us continue to sort of stagger along where we are right now, what would you predict will come out of the next budget in terms of balancing these numbers?
Look, what we are looking at, if we look at the ground reality right now, there's a lot of rural distress. So we firmly believe there will be expenditure reprioritization which will take place in the budget. And we may see a higher allocation for rural focus, something similar type what MP is doing, Madhya Pradesh is doing by buying crops for those crops for which there is no MSP as on date, announced by the central government. So we may see some sort of price stabilization fund and other things coming in. We may see more allocation towards NABARD so that under AIBP and other things for rural roads and other things. But yes, demand will always, is still a problem. And why it is a problem, I'll just try to take you look at, if you look at the national accounts from different type of institutions. So there is one institution called general government, which is center and state government. You have private corporates, so which have financial, non-financial. There's a public corporate, financial, non-financial. And there is a very heterogeneous group called households. Contrary to general belief that households is like individual, all of us sitting here, it is not only those, but even entire unorganized sector. Single, double, two people enterprise and all those. Now, if I look at the two basic things, whether I look at the savings or whether I look at the investments, this household as a group between 11-12 to 15-16 had 40% of the investment by this group. Private corporate 37%, public sector and general government again around 11% odd. And this is the group which has contracted. Their investment has contracted. Now, if we look same on the savings side, the savings rate of them is going down. So the demand which is generated by these people and they feed into the formal sector. They feed into the formal sector. It is not that unorganized starts with unorganized, ends at unorganized. No. They feed in, they provide a lot of inputs, intermediate goods to the formal sector. So the demand is likely to be a constraint even next year. Growth is likely to pick up from 6.5 this year. Unfortunately, I cannot give you the number right now because our report will be out maybe next week. So that's why I'm not giving a number. But growth, there will be incremental delta which will be coming in. But demand will, if we are saying, looking at 8% next year, I think nobody is talking about it. Even the most optimist is talking somewhere around 7.5 or so. But the problem is the number which was released by CSO, that number has a lot of moving parts in it. And until unless the big number of 2 lakh crore of discrepancy is resolved, because if that discrepancy goes and sits in the private final consumption expenditure, we'll see a growth there. So until unless that number settles down, which we believe by middle of February, when the CSO will come out with the new number, that will give a more clearer picture. But yes, we are looking at incremental delta, not a very strong demand. Government going to somewhere around 3.2 odd or so fiscal deficit this year. Yes, on state side, we may see some slippage in the 19.
Now, when you talk about reallocation of resources within the budget towards what you mentioned, handling rural distress, where will that money come from? So are you expecting to see a drop in government investment in infrastructure, or where would you see the government reallocating?
Look,
finance?
there are, look, what happens is whenever the budget is prepared, and Professor Panagaria knows ins and outs of it, and there'll be other government officials, those who are ex or present one. Lot of money remains unspent.
Right, okay.
All right. Now, they can reallocate small amount from different heads. Say from 100 different heads, you take out 100 crore.
Yeah.
That 100 crore will not make a difference to that head, but 100 crore into 100 will give you 10,000 crore additional. So that kind of reprioritization, you may see some scheme which you announced, say for 10,000 crore last year, but you see the expenditure, actual expenditure in that is 2,000 crore only. Right. And next year, we are going to expect only 4,000 crore. So why to allocate 10,000 crore? Allocate it at a place where there is a real requirement.
Right.
So it is that kind of
That'll be that
reprioritization.
game. So your hopes of selling OBT carpets to the government this year, not happening. Okay, sure, go ahead, Dr. Panagarya.
I just want to take on to this, this huge demand pessimism that is going on around here. Why are we not looking at the export markets? I think that was the question where you started with, Rudra. Now, let me give you just one example. The apparel industry, the garments industry. It's a total global market of $465 billion if I go by the figure for 2015. We exported 18 billion. China did 175 billion. Why are we not looking at that market? I think this whole focus that somehow the domestic demand is where I've got to be looking at, and this is where my market is where the big weakness lies. I think our industrialists, as well as I would say to some degree policymakers also, are simply too focused on the domestic market. The total share India has in the global market today, the export market in total, about 17 to 18 trillion dollars. Our own total GDP is 2.3 trillion. China exports about, $2.3 trillion in total, with a share of some 12-13% in the global exports.
Yeah.
Unless we go and increase our share there, I think, the robust 8% or 9% sustained growth is difficult. In the end, we got to conquer the export markets, and that is where the industrialists also need to look. So that is a pitch I want to make.
But I would also argue that my sense, at least with this government, has been that it has been gripped with a serious sense of export pessimism. It's extremely protectionist, is very unwilling to sign what I would consider obvious FTAs like the one with the European Union, which would make sense. But we may hopefully get into that. I'm opening up to the audience. If there's anybody who has any questions, please identify yourself. And if you're directing the question at any single person, please do so. Yeah. Is there any microphones? Okay.
Yeah, my name is Om Prakash Gupta. I am an independent consultant into mining and mineral subjects. First of all, I must congratulate and thank Professor Dr. Panagarya for the contribution he made while he was in Niti Aayog with the government. I really thank him, and I must appreciate his efforts, which are now getting the fruits. Second, my question to Dr. Panagarya is, while we are talking, all economists, we are talking of the GDP numbers and all that, you see, my question is that the spending, the kind of the amount of spending on the schemes like the farmers' loan waiving. You just waive off the loans given to the farmers, making the farmers intensely defaulters. Once they take the loan, they don't want to pay it, thinking that it will be automatically get waived. They go for the second loan, it gets waived off, take for the third loan, get waived.
You want to ask
so I want to ask Dr. Panagarya his views on this.
Yeah.
Whether this is scheme, because this is draining out too much money, which could probably be used for the schemes like hospitals and the schools.
So the impact of the farm loan waiver.
Yeah, so whether it should be discontinued or it should be continued. My question to Dr. Panagarya, please. Okay. This is a very serious issue, in my view.
So certainly, waiving loans is generally not a good thing, because, if you waive loans, then the fellows who were actually paying back their loans will feel, well, why in the world was I paying back? So agreed with that. But remember that, we live in a social ecosystem in which lots of poor people and lots of poor farmers. Politics of democracy inevitably will produce these outcomes. What you need to do is to manage. But at the same time, also don't forget what we are doing on the corporate side. Actually, the default rates, if you look at even the increased default rates after some of these loan waivers happened for the farmers, the default rates among farmers are much lower than what it is in the corporate sector. Really, if you are truly worried about the fiscal, that's where I would worry a lot more about. Not sort of condoning, I think we need to worry about the corporate side, the farmer loans as well, because it creates a perverse incentive. Whenever you look the other way when somebody defaults, it creates a perverse incentive. But in the end, there is an ecosystem in which we all live. And you cannot then go in and tell the farmers that I'm going to, for the corporates, I'll, give this massive maafi. But I'm going to hold you to your full commitments. One needs to have even-handed rules on both sides. I think we have not done that. That's one. And the other, I want to repeat that, in a political system in which there are a lot of very poor farmers there, democratic outcomes will give rise to these occasional happenings. But in the end, of course, this populism is not going to, is what is going to sustain. In the end, the people want growth. That is very clear, that the chief ministers who actually deliver, they come back. Deliver in terms of growth, they come back. Those who fail to deliver, in the end, get bundled out.
Okay. Gentleman in the back.
I think that might be me.
Okay.
Sonal, I work with the Institute for Transportation and Development Policy. My question is to Mr. Yokoyama. We work with cities and states in advising them on urban transport. And one of the things that we've realized is that tier 2 cities like Varanasi, Ranchi, broadly 1.4 million, 14 lakhs or so, are proposing projects like metro systems without even having functional city bus systems. And therefore, the narrative of investments, right, seems a little problematic over here, because if you look at a city like Varanasi, 50% of their trips or journeys are by walking and cycling. So if you have to look at 1 kilometer of street design, that would cost about 10 crores per kilometer. 1 kilometer of an elevated metro would be 250 crores. And 1 kilometer for BRT would be about 20 crores. Just a second, I'll come to the question. So how do we then rephrase this problem of the investment gap when cities may not even need the investments that they are being actually, they're being forced to kind of make. The second is, street design also is not looked at as bankable projects, and it seems that there needs to be some kind of education within development banks. The second question is gender neutrality in infrastructure. I think so far we've not really spoken about declining labor force participation of women. What can we do as far as infrastructure is concerned so that it becomes more responsive to women and girls?
I think just quickly, I think for the issue on metro and this integration into the urban transport system is a big issue. We fully agree. But for that, I think recently the ministry has issued a metro policy, which clearly stipulates that the metro project needs to be integrated with the comprehensive urban mobility plan. So it's not only metro, there must be the last mile mobility for the people through buses and walkability. So all these things need to be developed. And also, metro policy advocates the longer term planning of the urban areas, including land use planning, and also particularly mobilizing, capturing land value and revenue generation, and eventually whole urban investment can be financed by the municipality tax and private investments. So in a sense, I think India at large is, I think the GDP ratio of municipality tax mobilization is just about less than 1%, whereas the peer is having 3 to 4 percentage point more. So in that sense, there's a huge potential for urban resource mobilization as well. And of course, gender is an important element, and usually we advocate for the sufficient participation in the planning process to ensure that the gender friendliness can be ensured.
Last question over here.
I'm Dr. Ratnakar Gedam. I used to be advisor in the Planning Commission. I retired in 2010. My question is to Dr. Panigrahi. It is about development. If we see long back in 1998, there was a certain set up 10 policy, the guy advocated by this Williamson. They used to call this Washington consensus. Now, like that one, I mean, no policy prescription has been made by this planning Niti Aayog since its inception. Is there any, I mean, something like identifiable, though that is Washington consensus was long back, it was subjected to criticism, but at least to begin with, there was certain pattern of these policies. Now, Niti Aayog didn't do it, that is one way. So your comment on this one, number one. Number two is, you know, recently this, I mean, that budget, 2.11 lakh crores, that was the non-performing assets of this scheduled commercial, I mean, that public sector banks, which is to be equity injection government is planning for. Now, if that is going to be there, that means it is nothing but one kind of the siphoning out is actually the funds from this, through this back working system. Though there are, you know, laws, particularly about this insolvency and bankruptcy, what is the efficacy of those laws? Your comment, please.
Your question is basically whether Niti Aayog has made recommendations on this issue?
Yeah. What I was saying that identifiable policy, set up policy guidelines, at least for the government or central government. No, like that Washington, that consensus was there, wherever 10 policy guidelines are there. Right. If you do this one, your economy will grow. You will not fall into this one. I hope that you have understood that my Williamson's that consensus, Washington consensus, I was referring to that. No, okay, that is
First, your first question, I thought was about you're saying that we are not, Niti Aayog since its inception has made no policy recommendations?
No, that was like that one.
Yeah. But do you even read anything in your life?
Pardon?
You were advisor at the Planning Commission, but after that you stopped reading, is that it?
No. What I am
There was a whole 3-year action agenda that I did.
No.
Which was put out, and every single area is covered in that. Go and read it.
No, I read very well nicely. If you see that actually the digital part, this one, India, that is not exactly this actual policy guideline for that one, number one. Number two, if you say that it is inclusive growth without actually indicators, that is meaningless. If you say that inclusive growth of what? What are the actual output you are measuring for? That is one. Yeah. Another thing was non-performing assets. Those are increasing gradually, not only for the actually private sector banks, but even for the public sector banks. Now, what this actually Niti Aayog is doing for that one? That's why my second question.
Look, the NPA really is a finance ministry issue. From Niti Aayog, from day one, actually, when I joined in January 2015, actually, I was pushing it to even before the Prime Minister was elected, because I'd given a few briefings to him. I told him that, look, you know, this is going to be one of the first problems you will need to solve. But it is in the end the finance ministry whose job it is to solve the NPA problem, and it took much longer. The finance ministry took much longer. So it's just because Niti Aayog is there, you can't hold the Niti Aayog responsible for it. It can only give the intellectual leadership. It cannot. It's not the operational ministry for any of the activities. I mean, take privatization. Niti Aayog pushed it at a big time, actually. That even all the way up to cabinet, 30 public sector enterprises have been cleared by the cabinet, the Cabinet Committee on Economic Affairs, and it's been more than a year. Where the matter is languishing is actually in the DIPAM, Department of Investment and Public Asset Management. So you should, I mean, being an old veteran from the Planning Commission, you should know that even the Planning Commission was, except that it had a lot more money than Niti Aayog ever. Niti Aayog has no money. We really went in with purely our intellectual power. But otherwise, with the other ministries, even the Planning Commission had no power. So you can give the intellectual lead, and you can do a pushing from within. But in the end, it's the ministries which have to do things.
Rudra, I think you had one last statement you wanted to comment on Dr. Panagaria's original comments about the garment industry, and then I think we'll bring it to a close.
Just briefly, I think your point is well taken. Companies in India that are in export, I think in many industries we are becoming more and more competitive. There are, though, the points I mentioned about labor reforms and some other issues where many of these industries were regulated to remain in the small-scale industry, and many other factors that Indian industry has grappled with. there have been times that we have operated from countries outside India and succeeded, when the Indian division hasn't succeeded. And that is because there are huge advantages of India when we export. There is, like textile, we have massive history, very skilled artisans, but we also, to the example I was mentioning about labor issues, when we try to increase employment, it is a very serious decision. Just because we have to take a commitment which is a permanent commitment, almost. That was the only point I was making.
Well, thank you, gentlemen, for this discussion on the Indian economy. And I urge everyone to join me in giving them an applause, and we'll break. Thank you.
Token of appreciation to all our guests on the dais. Mr. Pant, Dr. Panagaria, Mr. Pramit Pal Chaudhary, Mr. Yokoyama. And we have very strong panels with us, so we will quickly have the changeover done, and within a minute or so, we will start. Strong, and we have some of the best minds who have gathered to speak on the world economy and the Indian economy. The stage as we would like to start. Mr. Sanyal, please join us. Tamal Bandyopadhyay and Professor C.P. Chandrasekhar.
I'm very happy to be here. As mentioned, I am with Bloomberg View, the opinion section of Bloomberg News, and I oversee our opinion coverage across Asia, which I've been doing from Southeast Asia the last 5 years, mostly in Singapore and more recently in Bangkok. And I'm always struck whenever I come to India from that part of the world at the differences. Obviously, the countries of Southeast Asia are much smaller, very open. Their growth has been dependent on exports for many decades now, and as such, they're highly attuned to changes, trends in the global economy. You come to India, and it's big enough and unique enough, and its media perhaps is self-referential enough that oftentimes the world can seem very distant, and developments there not necessarily relevant to what's happening in the Indian economy. At the same time, of course, India has grown fastest and strongest at times when global economic conditions have been most buoyant, and we seem to be entering another period such as that right now. As someone mentioned earlier, the World Bank noted this morning that the world is growing at or near full capacity for the first time since the financial crisis. All the major economies are growing to varying degrees in a synchronized fashion. At the same time, for India in particular, there are specific risks that are beginning to present themselves. Oil prices are rising, putting pressure on inflation and on government finances. The threat of protectionism and a possible US-China trade war is rising rather than falling a year into the Trump administration. The Fed and other major central banks are beginning to tighten their monetary policies. And meanwhile, Indian exporters, Indian companies are still struggling with the supply chain disruptions created by demonetization and GST, as well as the impact of a strong rupee. So there are risks as well as opportunities, and there are questions about how well India is prepared to deal with either of them. So luckily we have a fine panel here this morning who will answer those questions for us. On my left, I might start with Mr. Tamal Bandyopadhyay, consulting editor and columnist for Mint. Tamal, if you can just start us off by just laying out what you see as the predominant, the primary near-term risks to India from global economic development.
Thanks, Nishid. No, I have a slightly different take. I think this is, at this point, the global growth or the lack of growth and the opportunities and challenges for India is slightly irrelevant. because India is creating its own opportunities and to explore and to get benefit out of these opportunities and the creating that, the level we are facing our own challenges. Now, why I am saying that, I'll come to that, but I just give you a classic response. What are the risks? I mean, risk number one is oil. 2.5-year high, it's going. And our fight against inflation, of course, central bank played a very critical role, and so did the government, but the major contributing factor was the oil. So you can say about that. You can talk about US-China relationship and that's impact on Indian Ocean, where 60% of the petro products, all the vehicles fly through that. So this is a geopolitical risk. You can talk about North Korea, that could be a risk. You can talk about the elections in most of the Latin countries, whether Italy and Colombia and so on and so forth. So there are many risks and there are many opportunities. The second half of last calendar year, you see the remarkable growth. I mean, US, now you see the unemployment 17-year low. Barring UK, which is still lagging, but you see UK is growing. Yes, Japan consumption is down, but the external sectors is helping Japan. China, yes, the infrastructure construction down, but service sector is doing well. So among the BRICS and Euroland, again, it's a fascinating way they are going. There's a loose monetary policy and job growth. If you see about the BRICS countries, only Russia and South Africa, they have some issues, but rest of them are Brazil, it's fine. But have we been able to use the opportunities? Like for instance, the trade segment, if you see the global trade is pretty up in the last fiscal year. But if you look at the Indian context, if I'm not mistaken, between April and November, yes, Indian exports has have grown. I think more than double than the previous year. 2017, it was about 5% growth. 2018, it was about 12% growth. It's much less than Indonesia and Vietnam. Indonesia grew about 16%, Vietnam 24%. But if you look at our exports, these exports are primarily led by petro goods and iron steel. All the labor-intensive areas, the gems and jewelry and textiles, so on and so forth, they have not contributed at all. Why have they not contributed? Because, as I said, it's because of our own challenges. Our challenges are first the demonetization and the GST. So we are in a phase of deep structural reforms, and we would need to wait to get the benefit out of it. Is it 1 quarter, 2 quarters, or 4 quarters, or 2 years? I do not know. I mean, it's anybody's guess. Because it's a deep structural reform and it has the attendant challenges of the implementation. The implementation could have been better. I mean, the analyst can say that, the commentator can say that, but the ground reality is different and we are grappling with that. So the export is a classic example, I say, when the global trade is going up, when our other Asian countries have got the benefit, we have not got the benefit because of our own challenges. And then, of course, the banking sector and others that we can talk later. I don't want to. It's just a preliminary remarks. So my limited point I'm making is this. India in a cusp of, it's a change, it's a very different kind of change. And it doesn't really matter what's happening outside the globe. Unless you have a black swan event like what happened in 2008, the kind of Lehman crisis, that's a separate story altogether. But there could be many brown swans or gray swans, it doesn't really matter. We will not be able to get the opportunities with both hands at this point of time. Now, neither will be faced by the external challenges. Our challenges are created by us because of the opportunities we are looking for in near future. Thank you.
Okay. Professor C.P. Chandrasekhar from JNU University, maybe I'll turn to you next. Why don't I ask you a similar question? Do you see opportunities in this synchronized global growth that we're seeing right now? And if not, what is it that India needs to do to take advantage of those opportunities?
Well, let me begin by taking up something which you mentioned, which is the sort of signs of a certain asynchrony, if you want to call it that, between what is happening in India today and the evidence which seems to come out in terms of the buoyancy of the world economy, reflected in growth rates, high oil prices, etc. It's precisely at that point of time that we seem to see a tendency for growth to slip in India, a certain degree of uncertainty about sustaining high rates of growth that we have been registering, even though still rates of growth are significant. Now, I think this is important also because the way I look at it is exports for India is important from a balance of payments point of view, but we've actually not crossed that bridge where we can actually say exports constitutes the engine or the locomotive for growth. So, buoyancy in the world economy would have positive implications perhaps from the point of view of the balance of payments, but is really not going to be the trigger which sets off a revival or a recovery of growth or a movement of growth to levels which are necessary in order to make a transition to a middle income economy. Now, having said that, that does not mean we are not integrated with the world system. And I think what has happened over the last few years, but particularly after 2003, is an integration which has essentially come because of a growing dependence and therefore a sort of presence of large legacy foreign investments in the economy. That is, we actually are in a situation in which we need to be careful about the possibilities of either because of international developments or because of uncertainties at home, that there is a possibility that accumulated legacy capital would tend to move up because that can actually precipitate a set of events which can be adverse. Now, if you look at it from that point of view, I think also there's a second aspect to this large inflows of capital which occurred in the period after 2003 in particular, when India benefited much more than many other emerging markets from the surge in cross-border flows of capital. And that was the liquidity which came in, which is almost like an autonomous injection of liquidity into the system because of the large volumes of foreign capital which came in particular into equity and debt markets, resulted in a situation where if you look at the balance sheets of our banks, there was a huge expansion in deposits, and the credit to GDP ratio, which is about 19 to 22% continuously right up to 2003 from, let's say, the early 1990s, shoots up and goes up to about 60% of GDP when GDP itself, or 56% of GDP when GDP itself is going at the rate of about 7.5%, 8.5%. And that, I think, was quite crucial in stimulating the demand which generated the high growth of those years, because we actually saw, despite the beginnings of the implementation of the fiscal consolidation process after 2003 when the FRBM Act was passed, we actually began to see a significant expansion of debt finance, private consumption and private investment, including, of course, in infrastructure and housing, resulting in a situation where there was a substitution of debt finance private expenditure as an important stimulus relative to tax or debt finance public expenditure as a stimulus to growth because FRBM had become operative. And if this integration sort of gets stripped because of what's happening in the international system, partly because of the realization that the monetary policy focus over the last many years in the international system after 2008 has resulted more in the accumulation of fragilities in financial markets because of asset price inflation rather than actually generation of very high rates of growth. We are seeing some buoyancy now, but this is after 10 years. So if there is any possibility that there's a tripwire as far as this kind of dependence is concerned, while exports per se might benefit, we might actually end up with a situation where even what was a stimulus to growth could be affected, particularly because given the large accumulation of non-performing assets during this period when we had this credit boom, banks obviously are going to be more reticent to lend, and borrowers are going to worry about the overhang of debt which they'll have to address before they start borrowing again. I think that's really where the international system poses a threat in terms of the possibilities that rising interest rates, changed policies, etc., can reverse to a certain extent, or at least stall what seemed to have been a source of benefit for the Indian economy, but a source of benefit which also generates fragility.
Interesting. I'm going to follow up on a couple of points in there, but let me turn to Sanjeev Sanyal first, Principal Economic Advisor to the Ministry of Finance. We've been talking about near-term threats or risks to the Indian economy. Is that what you're focused on, or are there other issues that are more important to worry about?
First, let me point out that I have a side life as a historian as well. And one of the things that shows up in the long history of India, going back 6,000-7,000 years, is that India has always been integrated with the rest of the world and been influenced by the rest of the world except for the disastrous 50 years of socialism, India has always been integrated with the world. And so, whether it's trade, migration, technological change, India has always been a participant influenced by and has influenced outward the rest of the world. So, we have to take into account what's going on in the rest of the world. Now, the short-term story on this is relatively easier to work out, which is, as the other panelists have also pointed out, we are going through a synchronized upturn in the economy after a very long time. This presents some sort of export opportunity or whatever you may call, but on the other hand, it comes with various risks. One obviously is that the US Fed will begin, and ultimately even the Europeans will begin to withdraw liquidity. Not an easy task, because it's a knife edge. If you do it too quickly, you will end up causing dislocations in financial markets, which some would argue maybe even be over-inflated. And if you do it too slowly, you run the risk of inflating up the same bubbles that you were trying to avoid pricking. So this is a difficult job, but at least we know what the parameters are. I mean, whether it's quarterly GDP numbers, growth numbers, liquidity, monetary policy, etc., etc. The really tricky things, however, things that are happening at a meta level, which is potentially changing the entire game. And we really need to take cognizance of it and pay attention, which is this. We are going through massive technological change. Massive. If you aren't paying attention, you aren't opening eyes to what's happening around you. Whether it's artificial intelligence, drone and quadrocopter technology, what's happening in genetic technology, what's happening in robotics. I mean, I could go on, and the interrelationships with all of this. So much so that whether it's business models or the impact on social structures and labor mobility, how we design our cities, how we think about our education system, all of this is suddenly will have to be rethought. And those countries that are not able to deal with this will basically fall apart as far as being part of the world economy is concerned. This is really, really important. I want to stress this point here because many of you here are entrepreneurs. But remember, all of this also presents opportunities. So just to give you some feel of it, within 12 months or so, you're going to have Dubai, for example, have police patrolling in quadrocopter drones flying above the city. Just imagine this. It is already technologically possible, and the prices of this are rapidly falling, that quadrocopter driven by driverless artificial intelligence may become cheaper than driving around in cars. So just imagine what this means for how we run our lives. I mean, very, very quickly, at least ambulances, police services will move on to this. But I can see that, a decade from now, when you call an Uber, that Uber is actually something that flies to the top of your building. You don't go downstairs to pick it up, you go out to the top of your building to pick it up. And then it flies using artificial intelligence on some virtual grid. This technology already exists. And similarly, there are many, many jobs which people thought were safe. Things like lawyers and accountants. Many of these activities are going to get simply restructured dramatically by artificial intelligence. I mean, I could go on for a very long time. But the point I'm making to you is, you've got to deal with this quickly. And this will have to be done in everything, from the way we set up our taxation systems to the way we set up our education system. So let me give you one example, because I don't have a lot of time. Think of how our education system is set up today. What we basically do is educate people for the first 20, 25 years of their lives, and then we expect them to go out in the world and apply that knowledge. Now, in a world where you're having rapid technological changes, what this will mean is that those people who take decisions, who are in their 50s and 60s, are in fact the least in a position to deal with change, because they are the furthest away from when they gain knowledge. So you cannot deal with this world in this way. We have to restructure education systems such that people are continuously going through education as they go along. Now, that is not just, changing when you go back to school. That means where you build your campuses. You cannot build campuses now like IIT or whatever, 300 acres far away. People can't take 4 years off the middle of their lives to go and study there. You have to be studying continuously. So what you need is to break it down, have smaller campuses scattered around cities so that they can continuously go back to education. You have to begin thinking completely, rethink who is going to do the teaching. You cannot have somebody who did a PhD, 40 years ago is the expert in a subject. I'm sorry. You've got to completely think about this, the way this whole thing works. Bring in a lot more applied people into the education system and force people to continuously upgrade their skills in various ways. The point I'm making, this is just one sector. This, I could go on about how you have to change the design of our cities, how you have to change your labor laws. Bill Gates has, of course, famously talked about the idea of taxing robots. I think it's not a great idea, but I'm just showing you the extent to which we have to rethink things from scratch. And I think this is the critical thing as far as the big picture is concerned. Every country in the world will face this. We will face it too. And how quickly we face it. And also take advantage of all the opportunities that come. I mean, by the way, in India we have some advantages in the sense that we do not have resources locked up in many of the legacy technologies. We can leapfrog, just like we did with mobile telephony over fixed line. We could do that in many, many other things. So it's not something to fear. We have to embrace it. But we have to be open to the fact that the game is about to change.
Interesting. All right, Tamal, let me turn to you next and pick up on what Sanjeev was just saying. You mentioned that India is not taking advantage of rising global demand right now in terms of its labor-intensive exports. This is happening at a time when automation is coming in, and when automation is going to start taking away a lot of jobs in China, in Southeast Asia, jobs that don't yet even exist here in India. Is there time to create those jobs? Is there time to create a true export-driven manufacturing sector, or is it too late now?
No, actually, no, I didn't. What I meant is this: we are in the cusp of a big change, deep reforms. So in that sense, we are creating our own challenges to realize our own opportunities, and so that the outside world, it's not as relevant as it was 2-3 years back. It is now. That's what I meant. As far as automation and technology is concerned, I think, yes, everywhere, particularly the financial sector, which I closely track, I also see that we are going the other way. I was in deep in the hinterland of Karnataka, where I found a new small bank which India has created a little more than a year back. Big banners talking that we are, this particular entity is claiming that they are actually sanctioning a loan within 3 minutes. So I wish it's a sales gimmick. It's not true, because in this particular in the larger India, the Bharat, the hinterland, where people's job profile is very different. It's a very cash flow driven. They're not the white collar employees and all. How do you sanction a loan within 3 minutes? I cannot understand. So I think in the larger issues is this: we are the financial sector, some of the players have started peddling technology itself is a product. I think we are they're little ahead of their time. Technology is not a product, it's an enabler. If you start seeing it as a product, I think you are inviting trouble for yourself. Already you are saddled with bad loans, and you add to that more if you start technology. If you start saying, which some of the banks are claiming to say, that we also do banking, which something which one of the Tata companies used to say, that we also make steel. It's a very nice way of saying it. But if you are doing it in Bombay, Delhi and the metro, that's fine, which is you can map their activities, the white collar people and all, retail customers. But in the vast hinterland, where primarily it's a cash flow based way of looking things and all, this risk management is very different. Is technology taking away jobs? Perhaps, but also we are creating new jobs. All of us are talking about, some of the banks are now using artificial intelligence and robotics and knocking down people. But you look at the way how the back end of the banks of people are being more and more, they're more and more populated. Which was not the case 5 years back. I am associated as an advisor with a bank. I can see that. Yes, in the front end, maybe the number of people are going down, but in the back end, you are increasing the number of people. People are not talking about that. People are talking about the robotics and jobless. So I think it's not the right approach of saying that technology take away all our jobs. That's not the case. Technology is welcome. I am not against at all. But I'm saying there is some kind of misconception in certain areas. As far as jobs are concerned, yes, of course we need, and we are all struggling with the jobless growth they are talking about. I think the focus on how affordable housing, which the government has taken rightly, so that will be a big enabler and the creator of jobs, because it has a multiplier effect from steel and iron, even to education and school and everything and all. So I think the efforts are on, and its job creation is very important, but technology is taking away all the jobs and people are losing their jobs. That's the limited point I'm making, because on the other hand, if the robotics are taking away some people's job, at the back end more people are coming, because there's a new opportunities are working on and all. And as far as creation of job, yes, we are going through a phase again, as I said, the deep restructuring, which was long overdue, which is probably we are in a hurry. I hope that I think Prime Minister also addressed, some has said that he would like to consolidate now, because picking up one project after another, and it becomes difficult to take them to their logical end. Probably we need to consolidate what we have already taken up the task, and once the consolidation thing happening, whether it's GST, demonetization effect I think is now tapered off to that extent, but GST we are still struggling with. So once that new system is in place, which is much more transparent, which is certainly will help us in the, which I spoke about in the export sector between April and November, if you find that the labor-intensive sector's contribution is much less, it was primarily led by petro products and iron and steel products. I think that's going to change when we consolidate and once we get over the teething troubles. And another big driver of job, and the other part would be, I hope that the focus on affordable housing, which will have a multiplier effect and which will definitely give a boost to the economy and the job market.
Okay, so looking more to domestic demand than external demand. Professor Chandrasekhar, let me take up what you were talking about earlier. You mentioned a tripwire that might provoke a flood of capital out of India. Again, what can be done to prevent that? Is India taking the steps necessary to attract and keep that capital here despite the change in monetary policies overseas?
I think I should, at the moment, I don't think that the threat of a possible exit of significant magnitude comes because of uncertainties being generated domestically. That threat comes because of what is happening in the world economy, and as you know, even the Bank of International Settlements has recognized now that that this long period over which many central banks have maintained extremely low or even negative interest rates, combined with very large infusion of liquidity, really didn't contribute very much to displacing a fiscal stimulus as, with the monetary stimulus that can generate growth. But what it actually did was it has over a period of time resulted in some significant degree of asset price inflation. Even housing markets in some of these countries have revived, and prices are back to levels which they were. So there's a consensus, not merely in the US Fed, but elsewhere, that it's about time they started unwinding this. The Fed has started, the European Central Bank is going to do it. And one of the things which is going to which would happen, or one of the two things which would happen, is a rise in interest rates, and the other would be possibly an effort to try and hold back liquidity to the extent that the central bank has the ability to be able to do that. So if that happens, given the fact that financial players in equity and debt markets essentially operate on the basis of, differentials in rates, which is where they place their bets, that could provide a trigger for a reallocation, a portfolio reallocation of financial investors globally, including withdrawing to a certain extent from emerging markets. And if India becomes a victim of that, the disadvantage we had at one level in terms of a strong rupee would actually become an advantage from an export point of view, but can then trigger developments which, as you know, are determined purely on the side of the capital account rather than the current account of the balance of payments. And that would, what I was trying to suggest is that is not something which is merely a balance of payments issue, but because of the fact that the means of generating demand created by the large expansion in deposit base in the credit to GDP, that would get undermined, and which is why I'm calling it a tripwire, particularly because that seems to be occurring at a point of time when the ability of the system to sustain it even domestically is being undermined because of this large accumulation of non-performing assets. I don't think you can just blame bankers for having lent in large measure to infrastructure. If your deposit base is expanding hugely because of an infusion of liquidity, bankers can't sit on money because they pay depositors and therefore they'll have to earn. And I think that there was an implicit presumption that there was a sovereign guarantee from the state when they lent to infrastructure. And that somehow seems to have been withdrawn. And we have people in the policy establishment saying, oh, all of this debt was generated under the previous regime. Well, but the previous regime was also adopting a set of policies which allowed for this infusion of liquidity as much as this regime. So I think we need to come to terms with that. And the way I think a very positive thing is this effort to try and recapitalize the banks using money off the budget, even if the idea that is not actually an increase in fiscal deficit because there's no cash flow and inflow and outflow is problematic because it's debt financed. It's not debt creating capital receipts which is generating this recapitalization. So, but no point getting into that kind of a debate. It's a good thing for the state to do it. These are public banks. And now the idea is, how do you sustain demand without getting the banking system into a situation where it lends into areas which actually reproduce once again? Because if you look at the non-performing assets curve, it went down from about 20% or something down to 2% in the first phase of reform, and now it's gone from 2% to something like 12%. It's amazing V as far as, so you can't say that anymore that reform helped us set our bank balance sheets right. So it's in that sense, how do we sustain demand?
Do you have an answer to that question? I mean, it is the right question.
I do think that, I happen to be among minority which actually believes that this excessive obsession with fiscal consolidation in a context in which you have excess capacity, when you're having slow growth, when inflation is low, is problematic. In fact, I think the period of time when oil prices were low, in which we actually pushed this fiscal consolidation, was a great lost opportunity, because one of the problems we're going to face today is inflation is going to come from outside as well. But during that period, when we had this, we should have actually used the fiscal lever much more in order to be able to create the demand which will allow people to borrow without defaulting on their payments commitments.
Sanjay, that's a question I wanted to ask you. I mean, I know you're in the government now, but only in the last year or so. There is an argument that India did miss an opportunity in the first couple of years of the Modi administration, when macro conditions were especially healthy, to push forward some of these reforms that have been brought in more recently, that we're now dealing with at a moment when other risks and troubles are arising. Would you agree with that? Do you think that there was a missed opportunity there?
Well, one can always debate how the sequencing should have been done. But since banking has come up quite a few times, let me give you some sense of what the problem really was. See, you cannot think of banking, the banking problem, as separate from the wider issue that India's business system has had, which is that India's business system does not have creative destruction. And that this is critical to the idea of capitalism. Capitalism is not about the preservation of individual capitalists. It's about continuous churn. Now, this did not happen in India, partly because the banking system was used as a shock absorber, such that, in the good times, entrepreneurs or promoters made money. When the bad times, the taxpayers paid the bill. So now, it was important to impose some sort of order in this, one could even argue, not just economic, but political economic system that had perpetuated this for, since 1947 or even before that. So what was needed was to set the system, restart the system. And the first step to that actually happened in 2016 by the introduction of something called the Insolvency and Bankruptcy Act. That was absolutely critical, because without that, you could not liquidate and turn insolvent failed business. So if you think about it, as a market economy, as some sort of, risk-taking activity, obviously some of those risks will go bad. That's part of it. But unwinding those risks on an ongoing basis is absolutely critical. Exit is as important as entry. So that was the first peg that was put in place. Then, many people thought that the banking system should be cleaned up by the following way, is that take all the bad stuff up, put it in a bad bank. Many people a year ago, if you will remember, were talking about a bad bank. I and particularly, and some others also thought that that was a bad idea, because effectively the bad bank would be a warehouse for all these bad assets, and they would fester there forever. If you want creative destruction, then basically what you have to do is use the newly introduced IBC and liquidate and bankrupt many of those things that went down. This is not a moral point that is being made. This is part of the system of a capitalist economy. You have to continuously churn these things. So first a set of 12 large cases, which by the way accounted for 25% of the bad assets, were announced. Another 40 were announced. Together, that 12 plus 40 account for 2/3 of the bad asset problem. And now, as a result of that, and as it's happened to be, there has been a palpable culture change as a result of this. We've not had to go and try and solve every single NPA. Simply changing this 50 high-profile cases meant that there has been a palpable change in behavior that should be visible on your newspaper headlines on a daily basis. And this has changed the way we do business. Now, this is not to say we want to demonize entrepreneurship and risk-taking. There should be no social stigma to failure. Be clear on this, that the use of the IBC is not an attempt to introduce some sort of a socialist kind of worldview on the system. We are not socialists. This is part of the churn of a healthy economy. And I think this culture change is finally seeping through. People are getting the point of what we are attempting to do. The bankruptcy system is functioning reasonably well. You're beginning to see even those who are not in the bankruptcy system getting rid of assets which were, peripheral vanity projects. And the result of that is that what we are doing is absolutely deep-rooted changing of the way our financial system functions. So I think that is what is being attempted here. Whether we succeed or not, I'll let you judge. But I think that there is absolute clarity on what is being attempted. Now that culture hopefully has set in, and I think people have caught on to the fact that we are serious about this, we are now going forward and recapitalizing these banks. One can argue whether it should be above the line, below the line, etc. The point of the matter is, these are public sector banks. We need a banking system for India to sustain high growth, a banking system that is a multiple of the size that it is today. Some part of that will continue to be the public sector banks. So we need to get these public sector banks up and running again as quickly as possible. And that's why this thing that we are doing with the recapitalization being done. But again, notice that it is being done very clearly by imposing fairly strict capitalization norms and strict recognition norms. So no sense of humor about this whole thing. But we are clear what we are attempting to do. We were played a bad hand because we inherited many of these problems, but we are going to play it as well as we can.
All right, thank you. We are running a little bit late, so I'm just going to take a couple of questions from the audience if people have them. They have one in the far back there. Let me start with him. Is there a microphone to go around?